Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe. Welcome, everyone. My name is Sean Payne. I'm founder and principal of LivXplore Real Estate and Lifestyle. And today I have with me Isaiah Chass, our founding agent, and special guest, Stuart Broughton of Supreme Lending. Stuart, thank you for joining us. Isaiah, thanks for joining us.
Yeah,
Thanks for having me.
Cool. So we had you on maybe like a month ago or something like that at the end of 2022. And now we're trying to figure out what's going on for 2023 in the mortgage industry and real estate industry together that way. So first, I've been working with Stuart now, I don't even know how many years now, 10 plus years.
10 plus years.
Yeah. And he is a personal friend of mine, but we've become friends from working in the real estate industry and doing transactions together. And I speak very highly of him. I consider him the best in the business. Always very informed, great service, and great rates. And so if you have any lending needs in the future, if you need advice or what the heck is going on in the market in 2023, reach out to him. He's great. That's why we have him on here, because I think we're going to give you a lot of good information today. So let's jump into it, man.
Sounds good.
a lot of news, a lot of headlines.
Yeah, there is. There is a lot of news and headlines going on right now.
Let's talk about the mortgage market. What are your predictions for 2023 right now?
So I think personally for 2023, I think the first three quarters are going to be a little hard as far as volume wise for mortgages and just the amount of transactions for real estate as well. But what we went through in 2022 was a huge shift, obviously, with rates going up over 3%. And that really, took out all refinance volume and a lot of purchase volume. So the gist of it is there's, a lot of companies aren't going to be able to survive moving forward going through these three quarters. They might have survived through 2022, but, there's news of Wells Fargo rolling back from lending.
Yes.
That's a big one. Those guys are the biggest.
Right.
For years, and they're getting out of the correspondent business, which is mortgage banks like mine. They lend to us. We fund in our own name. We close in our own name. We sell to them.
Right.
They're pulling out. So that jumbo product, unfortunately, is going away. But we do have a lot of jumbo investors. But lenders like that, pulling out like that just shows what's happening right now in the current state of the market.
Right. Yeah, no, that's super interesting. We'll jump right into, might as well just jump right into like Wells and what's going on that way.
Sure.
Because I think you're seeing like the smaller and mid-level banks getting squeezed right now.
Oh, yeah.
They're going to have a hard time making through this market. But Wells, that's like the fourth biggest bank or something like that in the United States.
One of the biggest, yeah.
Yeah, so that they're backing out. And I think that their situation is a little unique. So they just had another class action lawsuit against them for $3.7 billion recently, just last week or a couple weeks ago. And that's after other class action lawsuits. So almost every year now, it seems like that they've been facing some type of class action lawsuits, doing something a little wonky, they're not supposed to. And so now I think that maybe just trying to get away from loans for, maybe just for public perception right now because of all the crap they've done in the past.
And also risk.
Right.
I think they want to, they were so big, you don't want to have, all your eggs in one basket as far as, having so many mortgages across the country in case there's a shift in values and so forth. So I think the risk factor was a big thing as well.
Right.
Yeah.
No, that totally makes sense. And just like I want to say is that I probably won't talk too favorably about Wells Fargo. They've never been like my favorite institution since the last foreclosure crisis. But, there are some lenders that professionally I respect. So it's not a reflection of them.
Right.
In fact, I feel really sorry for you guys, and I hopefully you find like a better position here in the near future. If this doesn't work out, which it sounds like it's going to get a little difficult over at Wells Fargo.
Yeah, it is. And I just think overall for the mortgage market, you're going to have smaller lenders that are really going to struggle.
Right.
They've burned a lot of their reserves through those last three quarters, pretty much. And I think it's going to be hard on those smaller lenders that don't have a lot of the capital. Because in order to do an independent mortgage bank, you need reserves and you need warehouse lines, you need things like that, and that's what's going to come into play. Is they'll probably switch over to the broker model where they don't have that risk, they don't need those funds up front.
Sure.
For that. So the places like Supreme Lending and other independent mortgage banks on a bigger scale, I think will survive this.
Sure. And part of that's because you have so many so many products available that
Correct.
if Wells pulls back, that you still have
We have
other
Chase,
options.
we have U.S.
Right,
Bank,
right.
we have a lot of other jumbo investors that we go through that has great rates as well. So
yeah.
And you can speak to this more, but I've seen since we've gotten away from the frenzy where I'd say most lenders have pretty similar rates. Now you're starting to see a big difference between rates and what programs different lenders have.
Right. No, it's true. Yeah, I think just products. You're going to see a big variety of just different rates and products from independent mortgage banks, credit unions, banks. So it is good to just be informed on what's out there. Mm-hmm. Yeah.
Cool. And it's talking about like maybe a difficult 3 quarters into 2023. A few months back when the market started changing, maybe like 6 months ago, I told some of the agents in my office, like, keep a journal because it would probably be interesting in the future when the market turns again.
Right.
But, I definitely feel like the message is changing now from like, again, we were talking about this a little bit yesterday. Like, 6 weeks ago, it was more like, hey, wait till June, and then there should be some inflation relief, and then rates will drop. And now it looks like it's being extended now, 3 quarters.
To the end of the year.
Yeah, to the end of the year.
Yeah.
So and again, like, I feel like, maybe 4 or 5 months ago, we talked about this. People in the financial markets felt that, like, maybe we're going to have a soft landing. So it's kind of gone from, like, soft landing, maybe a recession, to no, we're going to hit a recession, but maybe when June will be okay. And then now it's, like, extended out, like, 2023 is going to be pretty difficult that way. So the messaging's changing a little bit that way.
It is.
And I think that's typical. I think people try to remain positive. Like the last foreclosure crisis, I remember like, I have notes of like, hey, the market's going to drop 10% at most. And that was kind of like, I was new in the business, and I was like factoring, okay, this property's, listed at this and worth this now, but it's going to drop down to this value.
Right.
That prediction was a little off, It
was like 40%, wasn't it?
Yeah. I mean, the market took a huge, a turn. It's not going to happen this time. I don't think it's going to happen.
It's
anything
different.
like that. But nonetheless, the messaging's been kind of like positive, less positive, less positive. And so now I feel like we're getting to more
realistic outlook.
Right. Yeah. Because like before you're scratching, like you had such a good run, 12-year run. How can you not have a little bit of a pullback for a couple of years?
And
right?
I think the longer it continues of not having a pullback, the worse it will eventually get, right?
Mm-hmm.
Mm-hmm. Right. So I don't mean to put you on the spot, but like, I mean, for regarding rates right now, like over the next few months, where do you see them kind of just bouncing around where they're at, or what do you see happening now?
Yeah, I think the market's a little choppy as far as the bond market, mortgage-backed securities, and we've been, fluctuating in the mid 6s to low 6s, even up to 7 at certain points. I think we're going to stick around the mid 6s, low 6s on your conforming, government-backed loans. Jumbo's a lot better. Jumbo is high 5s now on a 30-year fixed at no points. We got ARMs in the low 5s.
Yeah.
So the jumbo money is going to be better priced. You do have to fit the box for those products, but I think we'll stick in that area. I don't know. I don't have a crystal ball. If we get some, a CPI index report that comes out that inflation's not coming down, then that could get worse. But I think it's going to fluctuate back and forth in the 6s, at least on the worst case.
Right.
Yeah.
I mean, it has to be until we get inflation under control.
Right.
That's that way. But I mean, it's good to know that like even with Wells pulling out, there'll still be jumbo products available.
There'll always be appetite for lending. Yeah.
And I like those ARMs. I still like those ARM products. I think
the ARMs are great.
I think that's we talked about this last time you were here. How those 7 and 10-year ARMs are really really good products. And what happens is like you get into that product, you're locked into that interest rate for 7 to 10 years. Correct. So you're safe right now. And then when rates drop, again in a few years, you can refinance into a longer 30-year mortgage where you're in a longer interest rate at a lower interest rate at that point.
Correct.
But in the meantime, here's something that will allow you to get into a property. As prices drop, allows you to get into a property. There's an opportunity there, and then in the long term, financially, that kind of makes sense. So,
right. And the jumbo products we have on the ARMs right now, they give rebates. So I have a client right now buying $1 million home, borrowing $650,000. He's getting a $5,800 credit at 5.5% on a 7-year ARM, and that ARM doesn't have any prepayment penalty. He does have to hold on to it for 6 months, but after that he can refinance anytime.
Sure.
And that $5,800 is a good rebate for your closing costs. So there are good loan products out there that as far as cost wise, I think are pretty good.
Right. Yeah. No, that's that's good that there's still going to be some products there and things will be able to move that way.
Right. And what I've learned, like past, through the '08 deal, is there's always an appetite for lending. And
Right.
it depends on who's going to be the player, who's going to come forth. Because if you look at the last 10, 12 years, you had, places like Washington Mutual, places like that went under.
Right.
And now you have the top players are completely different than that.
Right.
It constantly shifts. And
Yep.
Wells Fargo getting out of the, really stepping back from the lending, because what they're doing is they're getting out of correspondent, but they're also getting out of new retail business. So if a client doesn't have, checking accounts and so forth, or private wealth management relationship with them, they're not going to do a loan through them.
Right.
So, you're going to see new players come out.
Sure.
And I think, some big banks, hedge funds are starting to get into lending. There's the non-QM sector too, as far as
Right.
that type of lending. So there's always going to be an appetite, and there's always going to be loans. Just depends on who's supplying them.
Sure. Do you see that market, like the hedge funds, becoming more and more important this year?
Wall Street's going to have a big a role moving forward in mortgages,
Right.
Just because it will be profitable with the rates being as high as they are.
Right.
Yep. So
that makes sense. There's an
Yeah.
opportunity there. And we've talked a little bit about this. It seems like since the new year, and that's maybe people are just distracted over the holidays, but it seems like, and Isaiah, you can talk to this too, that there's a little bit more interest, just in the first couple of weeks of the new year, that like, I think everyone's getting a few more phone calls and, a few more questions that way. So,
I think first that we're through the holidays, that's a big factor. And I've had a couple clients, you probably more so, that are filing their tax returns and can finally get the ball rolling. So
right.
I've certainly noticed.
So even though interest rates are higher and 3/4 of this year is going to be difficult, there still are buyers out there, still looking to make things happen.
What I'm seeing is people, kind of poking their heads out that lost out over the last 2 years.
Yes.
Couldn't buy. You didn't have the biggest down payment. Weren't willing to go so far over, so forth. So these people are, okay, I can afford this interest rate, but I might get a little break on price.
Right.
And that sparks their interest, and that's a good ebb and flow.
Yeah, it's exactly what we talked about. Maybe they're using an ARM or something like that, but they're factoring in, okay, I'm going to pay a higher interest rate for these 3 years, but I'm getting this property
property price
at a lower price that's
Correct.
acceptable, and then I'll refinance in, and that's how this all works out.
Right. So those people are active and looking around.
Yeah,
So.
We've certainly seen that as well. So no, that's good. Anything else you see coming down the line that could affect the mortgage industry, or it's every day it's different? So
it is. I mean, there's new news all the time, and anything can change. But I haven't seen anything really regarding appraisals. That was always an issue back in '08.
Right.
You remember we were doing transactions where it was going to appraise and so forth. So I haven't seen any issues on that as far as things coming at value, but nothing's going crazy over asking. So that's been in line, and from that front, I don't see an issue.
Okay. That's an interesting point that you brought up, though. Certainly within the real estate industry, we're seeing a lot more noise about, buyers buying homes and then having a little bit buyer's regret. We kind of predict this. And so whenever that happens, there can be an uptick of like lawsuits, looking at, any kind of loophole that way. I'm assuming that you are seeing kind of those things or hearing that noise within the industry that way. Haven't some people gone out of servicing and things like that?
Oh yeah. I've seen stuff in just Housing Wire. That's a great source of real estate and mortgage information. But there's lawsuits all over the board as far as mortgages.
Right.
Mortgage companies suing other mortgage companies for losing sales force or whatever it is. But I think you're going to see more of that moving forward. Maybe not purchasing loans.
Right.
Maybe don't want to have that exposure of having those loans on their books.
Right.
So they're looking for them to repurchase back or things like that. So you're going to see a shakeout, I think, as far as lawsuits.
But I would think that as there's more lawsuits, that's when appraisers start getting nervous, because that's when lenders will be like, well, how did this appraise at this value? Because we know that market was just like, it was like basically like, okay, against a lot of more experienced agents' advice, it was, coming with no contingencies and the highest possible offer that you can afford, and that's what will get you your home.
Right.
And those are the people that probably are going to regret it now. And I just see that like as those lawsuits come out, people are looking around and be like, well, how did this appraise at that? And that's where I think that conversation may start again.
That's a good point.
It might be a little bit too early right now.
That's a really good point. You could start seeing that, especially if someone's property goes down, a certain percentage, since they paid so much more.
Right. Yep. So
I wonder though how much, with being that so many offers were non-contingent without an appraisal contingency, if you'll see that as much.
Well, it comes down to who's advising,
Right.
who's advising for the offer to be written that way.
Right.
So,
Right. But that was the norm. It was no loan contingency, no appraisal.
Yeah, no.
Or, sorry, get it's not going to work, and that was, on us, that was stressful.
Right. Oh, yeah.
Right?
I mean, here as well. So,
right. If you didn't vet that loan and make sure that they're going to qualify, you're doing that without a loan contingency. That's scary. So you have to really make sure it's going to go through. But yeah, not having that anyways is stressful.
I mean, it was so nuts because I don't know if we talked about this in the last podcast, but there was so many agents that got into the business, like 2019 or whatever, and they thought that was the norm. Like that was what you did. Like that was the normal process. Like, no, this is a weird 6 or 8 months that's happening, at least up in the North Bay area, right? And so. Like
you saw all the experienced agents not removing contingencies, all these new ones going with fully non-contingent offers, 20% over asking.
I think you came in one day and said, hey, they have 5 non-contingent offers. And I was like, man, I may have written 3 or 4 of these in my entire career. Right. And that's a unique situation where, the property's already been vetted to some degree or something like that. So and it was just like the industry standard, so.
Like with a country property, if you don't have inspections, right, you're waiving that.
The amount of country properties that they didn't have an inspection contingency without a well inspection or a septic inspection, I mean, that's crazy.
That is crazy.
Yeah, exactly. I mean, you got a lot of people coming out of metropolitan areas, coming up here and just wanting the property and doing that. So, yeah, it's going to get interesting. It's going to get really interesting that way. So, yeah, it feels, again, this is not like the last market, but a lot of the same things are happening, and I think like that's going to continue.
And I do think, I don't want to be negative as well, but I think, lenders are going to kind of tighten credit a little bit, just because of what's going on. And, so it's always good to get pre-approved up front. Get all your documents in. What we do is we fully underwrite the loan before we let the person make an offer.
Right.
Sometimes timing, you got to be quick and so forth, but that just saves a lot of stress and headache when you know that everything is going to fall into place and it does qualify, because you don't want to obviously go into contract and have something pop up. But I can't stress enough how important that is to do that all up front, just to make sure you got all your ducks in a row.
Yeah, that's such a great point. That really, even in a crazy market, and you're like, even if you're not anticipating buying a home right now, but you're thinking, hey, I'm a few months down the road, get ready now. Oh yeah. And then to update a file, it's pay stub.
Easiest thing ever.
So easy, right?
Pay stub,
right?
Bank statements. If I have to pull credit, that's all easy stuff on our end we can do, but it's so important to make sure that's all in line.
Right. We get this question I think a lot right now, where there's a misconception that if you get approved now, within 2 months you're gonna have to resubmit this, and that process is just so much easier. It's pay stubs, it's just basic, very easy information. You're good to go that way.
Right. And at the very least, then you know what price point you're looking in. You could be approved for $200,000 higher or $200,000 less than you think you might be looking at.
Right.
That in this market where there's less inventory and that home comes on the market and 2 months earlier than what you were anticipating, you don't want to lose out on that home. One, it's going to be less competitive going after it, so it's going to be an opportunity. But two, if you lose out on that home, it's going to be a lot longer for a home similar to that to come on the market, because inventory is restricted that way. So yeah, get pre-approved, get ready, and then sit and wait. There will be opportunities. There will be opportunities this year and in the future that way.
And I think what we've been doing a lot with my team is 12-day closes. Even though things have shifted,
right?
Sellers still want to close earlier, and there might be only maybe 2 offers on a property, but that 12-day close does really stick out.
Yeah,
it really does.
I mean, that's another great point. It's almost like a cash offer in that sense, where it's so quick. Where especially sellers right now, they want a certain value. The market's dropping, so we're in a market now where you're often not writing it at full price. It's like, hey, that's not where the value is. This is where it's at.
Right.
And so to have a quick escrow and be like, hey, it's not the value that you want, but you can have your money in 12 days.
Right.
Like that really does help. It's like a cash offer in that sense.
And appraisers are very quick right now.
Right.
So that's not a problem to get that done. Sometimes you get an appraisal waiver. What I've seen lately is not a lot of appraisal waivers. And I don't know that's because there's a shift in the market.
I would think so.
With Fannie and Freddie. Right. But the 12-day definitely sticks out.
Right.
Even with less offers.
Yep. Yeah. That's great. That's great to know. So if someone wants to get a hold of you, what's the best way to do that?
You can call my cell phone, 415-987-8184, or my email, Stuart, Stuart.Broughton, BROUGHTON, @supremelending.com.
Cool.
Feel free to call me, email me. I'd be happy to help in any way I can.
Sounds good. Well, thank you so much for joining us today. We'll have
Thanks,
you back
guys.
on in a couple months,
Yeah,
but this is
absolutely.
really informative as always. And I can't emphasize enough that even if you just have a mortgage question, even if you're not looking to refinance, you're like, what does this mean? Or you're confused. Give this man a call. Very informative, very easy to talk to. Not greasy or slimy in any way. Really good guy that way. So I really enjoy working with him.
Thank you.
So yeah. So I'm Sean Payne, founder and principal of LivXplore Real Estate and Lifestyle. Thank you for joining us today. If you enjoyed this episode, please hit like and subscribe so you can see future content. Isaiah Chass, thank you very much for joining us.
Absolutely.
And
Thanks, Stuart.
on to the next one.
Yep. See you guys next time.
Welcome to the LivXplore Podcast. If you like what you hear, please hit like and subscribe.